Welcome back to Investing Talk Podcast.
Today, we're looking at Chevron.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For anyone keeping an eye on the energy sector, Chevron has, it's presented a uniquely compelling story for the next few years.
Right.
If you look at the immediate financial snapshot, say Q3 2025 revenue, it was $48.2 billion.
Okay, which on the surface was actually a little down year over year.
It was, yeah, by about 1.5%.
Yeah.
But honestly, focusing on that one past quarter is, it's missing the entire point of where the company's headed.
That's the crucial pivot, isn't it? The past is just context. When we look forward, the number that really just jumps off the page is this projected $12.5 billion incremental free cash flow boost.
Exactly.
Expected to hit by 2026. And that word, incremental, that's the key. It's not their current cash flow. It's an additional $12.5 billion on top of it.
It's massive. And we really need to understand the magnitude of that.
Yeah.
To put that number into perspective, it's a cash injection that just fundamentally changes their capacity for capital return for future investment. It's not just, sudden oil price spike. This is structural.
And for anyone who might be newer to this, when we say free cash flow, or FCF, what exactly are we talking about?
Right. It's the cash a company generates after it's paid for everything it needs to maintain and extend its operations.
Yeah.
It's the money that's truly available for, dividends, buybacks, paying down debt.
Okay, so if this is coming from structural change, where exactly are these faucets opening up?
It's a beautifully orchestrated three-part plan, really, all centered on this massive upstream growth.
Okay.
First, and this is probably the most familiar one for listeners, is the Permian Basin.
Right.
They're just significantly ramping up production there. We're talking volumes expected to exceed 1 million barrels of oil equivalent per day.
1 million barrels a day. That's a massive amount of output from a single basin.
It is. The Permian is their short cycle engine. It's fast, flexible, and incredibly efficient.
So that's one pillar. What are the other two feeding this surge?
The second pillar is the ramp-up of the Tengiz Future Growth Project. This is a colossal expansion project over in Kazakhstan.
Okay, I've heard about this one.
It's a long-cycle, high-impact project that's been in the works for years, and it's finally getting to full capacity. Tengiz is essentially becoming one of the world's lowest-cost producing fields.
So the sheer volume from that alone will sustain cash flow for decades.
Decades, exactly. So the Permian gives them flexibility now, and Tengiz provides that long-term, low-cost backbone.
And the third source?
The third is Gulf of America developments, specifically deepwater projects. These are highly profitable, very complex, but they offer decades of production stability.
So it's a strategic mix: short-cycle shale, massive long-cycle projects, and then high-margin deepwater.
You've got it.
But here's the thing that gets really interesting to me. Increasing production usually means increasing costs. Yet they're projecting $3 to $4 billion in structural cost reductions by 2026.
Right.
How do you pull off massive volume growth and massive cost cuts at the same time?
That is the secret sauce that separates them from a lot of their peers.
Yeah.
The cost reductions are coming from digitization, from standardizing their drilling templates, optimizing supply chains, and integrating their massive new assets like Hess. That adds immediate scale.
And synergy opportunities.
Exactly. This focus on efficiency is what allows them to target industry-leading profit margins. They're literally making more cash on every single barrel, even if the price of oil just stays flat.
And this isn't just a 2-year story, is it? Looking further out, the analysts seem to be baking this in for the long term.
They are. The expectation is for over 10% compound annual growth, or CAGR, in adjusted free cash flow right through 2030.
And for our listeners, CAGR is basically the average annual growth, smoothing out the bumps.
Right. And achieving 10% FCF growth annually, even if you assume Brent crude just hovers around $70.
Yeah.
That shows incredible confidence in their operations.
Okay, that operational picture is incredibly compelling. But let's shift gears a bit. A huge FCF boost is only good if management is disciplined with it. So what does this mean for the shareholder?
That discipline is maybe the second most important part of the whole investment thesis. Management has been crystal clear. They've set a hard cap on their capital expenditures.
How much?
Between $18 and $21 billion, right through 2030. They are not going to chase every expensive new project just because they have the cash.
I want to challenge that a little bit, though. You see other majors like ExxonMobil or BP, and they're under immense pressure to ramp up spending on renewables and the energy transition.
Sure.
So is that strict CapEx cap a sign of discipline, or are they sacrificing the future?
It's a fair question, and it's where their strategy really differs. They see their main role as providing energy reliably and efficiently while returning capital. Their low-carbon strategy is more integrated, focusing on making their oil and gas production less carbon-intensive.
Instead of big speculative bets on new energy sources right now.
Exactly. The discipline ensures that cash goes back to investors, not into projects that might not have the same high returns as their core assets.
And that focus on the core seems to pay off, especially when you look at risk. I saw a surprising fact here. Their free cash flow covers their dividend and all their needs, even if Brent crude drops below $50 a barrel.
That is a huge selling point for any risk-averse investor. It means they're protected against the kind of volatility that, crushed the sector just a few years back.
And that comes from having low lifting costs.
The lowest among the majors. The cost to get a barrel out of the ground is just remarkably low, thanks to the Permian and the scale of projects like Tengiz.
So let's connect the dots. They're generating all this cash. They're disciplined on spending. How does that translate into shareholder value?
It directly funds a massive shareholder return program. First, buybacks. They're expecting to spend $10 to $20 billion a year on them.
Wow.
Which, if you project it out, means retiring between 3 and 6% of the company's total shares every single year.
Which mechanically boosts earnings per share for everyone who's left.
Right. And second, the dividend. It's yielding around 4.5%, and they have this truly remarkable streak of 38 consecutive years of increasing it.
That says a lot about management's commitment, even through tough cycles. So for 2026 specifically, where is that 18 to 19 billion in CapEx going?
It is laser focused.
Yeah.
It's going right into those high return upstream assets we talked about, speeding up production in the Permian and finishing projects like Tengiz. Every dollar is spent to maximize productivity, which feeds right back into that FCF growth target.
This all raises a question. Why is Chevron able to do this when other majors face more headwinds? What's the competitive moat?
The moat is the structure of their portfolio. It's like a diverse investment portfolio built to weather any storm.
Yep.
I call it the triple threat portfolio. You've got flexibility from the short cycle shale in the Permian. You have stability from huge global assets like Gorgon and Wheatstone, which provide reliable LNG supply.
Which is a key global demand insulator.
It is. And finally, you have that high-leverage deepwater position in places like Guyana and the Gulf of Mexico.
So if oil prices are high, they can step on the gas in the Permian. If demand shifts to natural gas, their LNG operations are a hedge. It's like an insurance policy.
Precisely. And the data shows their low carbon intensity relative to peers like ExxonMobil and BP. And that isn't just an environmental talking point. It's a financial one. It means fewer regulatory hurdles, lower transition costs.
Can we actually quantify how stable they are? Is there a metric for that?
There is. Their price sensitivity. The company has a remarkably low sensitivity to crude price swings. A single $1 move in Brent crude only impacts their after-tax earnings by about $550 million.
Which, for a company with $48 billion in quarterly revenue, is basically a ripple.
It's a fantastic demonstration of their stability.
Okay, the fundamental thesis is incredibly strong. Now let's pivot away from that to what's happening in the market right now. The stock recently climbed to about 155, reflecting some positive sector momentum.
Yeah,
Do the technical signals back that up?
they absolutely do. The technical picture looks pretty constructive. The stock is trading above its 5-year median PE ratio, which is about 11.8.
And for our listeners, PE is just a simple way to measure if a stock is expensive or cheap relative to its earnings.
Right. So trading above the median shows increasing confidence.
And what about some of these chart patterns? I hear buzz about something called a golden cross. What is that and why does it matter?
A golden cross is a key bullish signal. It happens when the shorter-term 50-day moving average crosses above the longer-term 200-day moving average.
Yeah.
It's often seen as confirmation that upward momentum is building and that the stock has entered a long-term bullish phase. It suggests this rally isn't just temporary noise.
And analysts have identified support levels between, $141 and $146? Why are those numbers important for an investor?
Those support levels are critical because they represent price points where buyers have historically stepped in aggressively. If the stock pulls back, hitting that range often signals a low-risk entry point. It suggests long-term investors are ready to defend that floor.
And beyond the charts, the general market sentiment seems positive. We saw that recent $120 million Frontera crude prepayment deal, and there's a lot of anticipation for the late January earnings release.
And you can't forget the long-term endorsements. It's still a dogs of the Dow stock.
Right, one of the 10 highest yielding stocks in the Dow Jones Industrial Average, often seen as undervalued.
Exactly. And that high yield, combined with the fact that it's still a Buffett favorite, creates this really strong narrative of stability for institutional investors.
That confidence must translate into institutional buying.
It does. And the sheer scale of that $10 to $20 billion buyback plan creates automatic accumulation. Institutions know that when a company is retiring that many shares, it creates a constant mechanical demand for the stock.
We should probably briefly touch on the speculative stuff too, right? The buzz around AI data centers needing more energy, or the geopolitical situation with Venezuela spiking prices short term.
Those are interesting factors for sure. They could turbocharge a short-term move, but they don't underpin the core thesis, which means we absolutely have to balance this and talk about the primary risk.
The bear case.
Yes, the biggest uncertainty is geopolitical.
It's the Venezuela question, isn't it? The possibility of sanctions being lifted.
Precisely. If sanctions on Venezuela were fully lifted, that country's massive oil supply could potentially flood the market.
Which would put sustained downward pressure on crude prices.
Exactly. That could cap Chevron's free cash flow increase if Brent were to slip below that crucial $70 mark for a prolonged period.
But again, we have to put that risk in context. Does that threat matter as much to Chevron as it might to say, a higher cost producer?
No, because of those resilience metrics we talked about. The fact that their FCF coverage is intact below $50 Brent means they can absorb that disruption better than almost anyone. A $10 drop in Brent only impacts their production by about 10,000 barrels a day. They are built for this.
So for you, the listener, what should you be watching on the calendar to confirm or challenge this thesis?
The most immediate critical event is the late January 2026 earnings release.
Okay, and what are we looking for in that report?
3 things. 1, updated production guidance, especially on the Permian. 2, concrete results on their cost performance. Are they on track for that $3 to $4 billion target? And 3, updates on the Hess integration.
And beyond earnings.
Keep an eye on the upcoming OPEC Plus meeting doing it. Their decisions always move the sector. And then the broader macro trends. What's happening with Venezuela supply, and our interest rate cuts coming, which could fuel rotation into energy.
So to synthesize this whole investment case.
The core argument really hinges on 2 things. The combination of a protected, integrated portfolio and that massive, unavoidable $12.5 billion free cash flow surge coming by 2026. That cash boost is the engine supporting everything for shareholders.
So here's the concluding provocative thought for you to chew on. If this company has proven it's financially resilient and can cover all its needs when Brent oil is below $50, how much truly exponential upside is baked in if that expected 10% plus cash flow growth holds true through 2030? And what does that protected trajectory mean for your total return compared to maybe higher risk growth plays?
Make sure you hit that subscribe button so you don't miss our next analysis.